Okay, welcome you all to this video, and in this video I will show you about the method to calculate free cash flow and also bring those calculation for NPV, IRR, and financial returns calculation. Okay, so you can see that basically once we are working on the financial model, the basic approach is that we distinguish two things. The first one is your input. You can see that based on the case study, I put them in value. Okay, so apart from this assumption, please do it by formula. Okay, so just this, put it on value. After that, please make it in the formula. Okay, so for example, in the sales, okay, you should put it like this. Sale for year one, it is equal to open parenthesis sales multiplied by unit price and divided by 1,000. For example, like this. Okay, so if you want to log them, just put F4 like this. So it will log the cell to C6, okay, and also with C7. I usually see some of our friends do it like this. 100,000 multiplied by 260 and divided by 1,000. Okay, no, don't do it like this. So once you complete this thing, and then you see that sales for the first 4 years, they are all equal. So just paste it in terms of function. Okay. So like I told you in class that my model include of 18 lines. You can see that this is 18 lines model. So I put this number here, and then I hope that you can catch up and compare with the thing that we discussed in class. Okay, so right now we will move it one by one. Okay, so right now we complete with the sales already. Then we should think about the cost. Okay, and if you have a look here, per unit cost is 110. So right now we should calculate the cost of goods sold. It is equal to your units, okay, and then log by F4 multiply by your per unit cost here, F4 again, okay, and divided by 1,000. So and then you copy and paste in terms of function. So right now you can see that we finished with the first and the second lines. Okay. Then the third line is about gross profit. It is equal to the summation of these two lines. Okay, here. So here right now you finish your gross profit. Okay. So then we need to calculate those expenses. For example, SG&A and research and development. Okay. So the thing is that the next item, as I mentioned to you in the class, that we have relevant costs and also a relevant cost. So feasibility study is relevant. Okay. Relevant. Upfront R&D. If you see the word R&D, it means that if you make a decision to go on with the project, this is your upfront cost. Okay. And let me have a look in the case. We also have incremental annual overhead. Okay, we also have an incremental annual overhead. So investment in new equipment here is the capital expenditure. okay? And then for the increment annual overhead, this is relevant cost, okay? So in your real life, you will see that there are several costs. So you need to distinguish among them, which one is relevant, which one is irrelevant, and which one is the capital expenditure, okay? So based on this case, it means that you need to put it here, okay? F4 divided by 1000, okay? So right now, you know that this is your incremental and no overhead, okay? So you use this one already. So one of the skill of the financial models that you need to put it in terms of formula. So when someone asks you about changing this assumption, it will be automatically calculate for you, okay? We also have upfront R and D, and that is here. The upfront, it means that you pay it at the beginning. It is the meaning of the upfront, okay? So here, 15,000. Also, this is your capital expenditure, and then lifetime is 5 years. So your depreciation, it is equal to this investment divided by 5, because that is the lifetime of that equipment. And don't forget to divide it by 1000, because remember, one of the mistakes that many of our friends usually do is that you forget this 1000 units, okay? So right now you calculate depreciation already. So you put it as a function here, okay? Right now is your EBIT. It is equal to the summation of from line 3 until line 6. Okay, line 6. Okay, that is here, your EBIT. Like right now, it looks good. Okay. Then if you have a positive EBIT, you need to pay income tax. Okay, so it is equal to if logical test. If your EBIT is more than 0, okay, then the value is here multiplied by your EBIT, and it should be minus sign, okay? Otherwise 0, okay? You can see that right now the tax rate in this case is 40, okay? So here you can see that in year 5, in the 5th year, your EBIT is negative. That's why no need to pay tax, okay? Like I mentioned to you in class that in this video, when we calculate this case, we should distinguish between investment decision and financial decision. Investment decision is all about this project, but financial decision is just about how you raise fund or your capital structure. So we distinguish that, and then we talk about debt modeling after this, okay? So here is your unlevered net income, okay? That is a summation between that two lines. Okay, everything looks good, okay? As I mentioned to you that depreciation is just an accounting expense, so we need to plus it back, okay? So here we plus it back. You can see that actually this is the accounting expense. It means that we didn't pay it in the real cash flow. Then your capital expenditure, okay, is here. It is equal to minus this one, okay, divided by 1000. So you can see that when we think about the upper part of this table, we talk about projected income, and when we talk about the following part, we talk about free cash flow, okay? Then based on this case, we don't have any residual value or terminal value, okay? So the thing is that we need to calculate these numbers together, okay? So receivable is 15% of sales. So it is equal to minus 15% of sales, okay? Multiplied by sales. And then don't forget to lock them, okay? Don't forget to lock them. So I will put it like this. You can see that right now. Everything is very nice. And then payable, it is 15%. But you should compare, but on this case, we should compare with the cost of goods sold, okay? But it should not be minus, okay? Because that is the money that you have to pay it, but you haven't paid it yet. So here is your working capital. Working capital. So, oh, sorry. We should put it like this. Okay, that's good. Right now it is almost correct. Okay. So increase in net working capital. It is equal to net working capital minus by net working capital for the previous year. Okay. So you can see that based on this case, you need to inject working capital in year one, but later on, because the sale doesn't ramp up, so net working capital remain the same, okay? And then later on, you need to know that you need to release all working capital back, okay? So because this is increased, so it means that in year one, you need to increase your working capital, but in the year 5, you need to release all of them. So increase in net working capital, it is equal to minus this row, okay? Okay, everything looks good. So when you work on your own project, when you work on the real case, please beware about this. Remember that by the end of the project, you need to return your working capital, okay? So right now we're gonna calculate free cash flow together, okay? So here, everything look pretty well right now, you see? So congratulations. Right now you complete your free cash flow calculation. And we're gonna calculate the most exciting part together, which is net present value. Okay, so this is your net present value. One of the things that you need to be very careful is that you need to select only on the future cash flow, okay? Because at year 0, that is the present value already. So right now, congratulations, you finished with the calculation for the free cash flow. What I'm gonna show you here is that I did one thing wrong and one thing right, okay? So please keep in your mind that when we calculate NPV, we should calculate it from the free cash flow only. We should not calculate them from the unlevered net income, okay? This is wrong, okay? This is right, okay? And then the wrong calculation will lead you to the accept of this project because you think that this NPV is positive, that in fact the NPV is negative. So we should reject this project, okay? So this is wrong. So based on this video, I introduced to you about 18 lines model, okay, that will help you to calculate any of the financial feasibility studies projects. And see you again in class. If you have any question, feel free to let me know, okay? Thank you so much. Take care.